Imagine losing 110% of your investment in a single afternoon.
Yeah, which is terrifying to even think about.
Right. And not because a massive company went bankrupt or, because of some sudden catastrophic stock market crash.
No, nothing like that.
You are completely wiped out just because a central bank official in Washington cleared his throat, changed his tone of voice slightly, and shifted a median projection by a tiny fraction of a percent.
It sounds absurd, but it is exactly what happens.
It really is. Welcome to the Deep Dive. Today we're taking a really close look at a dense, highly technical trading analysis from June 20, 2026. It's titled Fed Rate End of 2026 Odds, a leveraged trading analysis.
Which I know sounds a bit dry on the surface.
Oh, totally. Usually, talk about the Federal Reserve's interest rates puts people right to sleep. But our mission today is to extract those core sort of aha moments from this source. We want to show how decentralized prediction platforms, places like Polymarket and Predmart, are actually mapping out the future of the economy.
And doing it in real time. It's really a high-stakes leverage battlefield over there.
Exactly.
Yeah.
So by the end of this deep dive, you won't just understand what traders think the Fed will do next. You'll actually understand how money moves in the shadows of these probability markets, way before the news even hits the front page.
Right. We have to set the baseline first, though, to understand the carnage.
Oh yeah, the carnage. Set the scene for us.
So looking at the source, back in early June 2026, the effective federal funds rate is sitting comfortably between 3.5 and 3.75%. That was the anchor. Everyone was pretty
The
calm.
calm before the storm.
Exactly. But then this explosive recent event completely fractured what traders thought would happen by December. It turned this sort of boring academic forecasting exercise into an absolute bloodbath.
A bloodbath driven by what the source calls a hawkish shock. And the catalyst for all this chaos was the June 17 FOMC meeting. This was Fed Chair Kevin Warsh's big debut, right?
Yeah, his very first one as chair. And the narrative contrast is what really drove the shockwave here. I mean, think about March. Back in March, 0 officials, literally nobody, was projecting any rate increases for the rest of the year.
Right. The consensus was just to hold steady.
Exactly. But fast forward to this June meeting, and suddenly, out of nowhere, 9 out of 18 officials are projecting at least one rate hike before the end of 2026.
Wow. Half the board just flips their stance in a few months.
Half the board. And that structural shift pushes the median year-end projection up from 3.4% to 3.8%. A massive 40 basis point move.
Okay, let's unpack this because I want to play devil's advocate for a second.
Sure, go for it.
If the current rate is roughly 3.5 to 3.75%, and the median jumps to 3.8%, isn't that just like a tiny, boring 25 basis point hike?
Mathematically, yes.
Right, because for the real economy, that's just statistical noise. It barely changes the monthly payment on a standard 30-year mortgage. So why is the prediction market freaking out over one tiny hike? It's like changing a weather forecast from clear skies to a hurricane warning overnight.
Well, it's because these financial markets, especially the leveraged prediction ones, aren't actually pricing in the absolute number. They are pricing in the derivative, the trajectory.
Oh, meaning they care more about the direction we're heading.
Exactly. A pivot from a hold regime to a hike regime changes the entire gravity of the system. It tells the market, hey, the central bank's threshold for tolerating inflation is gone, and they are willing to actively destroy demand to fix it.
Which changes everything for investors.
Right. It forces an immediate repricing of risk across every single asset class. And on these prediction platforms, that realization was basically rocket fuel for the 4.0% rate contract.
Yeah, the source points out that traders aggressively piled into the 4.0% outcome, making it the new frontrunner at a 35.5% probability.
Which makes mechanical sense. One standard hike from the current bound lands you exactly on that 4.0% target.
But because it's a closed probability market, if one contract surges, the money has to come from somewhere else, right?
It does. Probability mass has to flow. The money backing the status quo just completely evaporates.
And that brings us to the biggest mover in the analysis, the collapse of the 3.75% contract.
Yeah, this was the safe bet. Before Warsh's pivot, the 3.75% bucket, which was basically the Fed hold steady bet, was the overwhelming favorite at 38% probability.
And after the meeting?
Panic selling drove it all the way down to 29.6%.
Okay, wait, an 8.4 percentage point drop doesn't sound lethal. Like, oh no, I lost 8%.
When you have to introduce leverage, that's the key.
Right, the 5x leverage mentioned in the source material. This is where it gets crazy.
Yeah, because a prediction market contract trades between 0 and 100 cents, matching a 0 to 100% probability. Moving from 38 cents to about 29.5 cents is roughly a 22% decline in the raw value of the underlying contract.
Okay, a 22% loss is bad, but it's not a wipeout.
Unleverage, sure. But if you're trading with 5x leverage on a platform like Predmart, you only put up $1 of your own money for every $4 you borrowed.
Ah, so that 22% decline on the total position completely erases your 20% equity stake.
And then some. You're left with a 110% loss.
And the platform doesn't just wait around for you to wire more money from your bank account to cover the difference, do they?
Oh, absolutely not. The liquidation engine kicks in immediately. It seizes your position and force sells it at the current market price to pay back the borrowed capital.
Which just dumps more contracts onto the market.
Exactly. And that force selling drives the price down even further, which triggers the next guy's margin call. It's a cascading mechanical failure for anyone caught holding the wrong narrative.
That is brutal. But it also creates a massive opportunity for the people on the other side. The source calls it the flow thesis.
Right, because that zero-sum probability mass has to go somewhere. It flows upward toward the higher rate contracts.
And the math on this is staggering. If you buy into the 4.0% contract when it's sitting at 35 cents, and market sentiment pushes it up to a 50% probability,
You capture a 43% return, just buying at 35 and selling at 50.
but at 5x leverage, that 43% return transforms into more than a 200% gain.
Yeah, you more than triple your money.
And here's the crazy part to me. You don't even need to hold the bet until December to make that fortune. You don't actually need to be right about where the Federal Reserve sets the rate at Christmas.
Not at all.
You just need to be right about the direction the crowd is moving today. Direction over destination.
That is the defining law of leveraged probability trading. You are just purchasing momentum. But that momentum is entirely tethered to real-world triggers.
Right, the macroeconomic data. So let's map out this battlefield. If the main fight right now is between the 3.75% hold and the 4.0% hike, what external factors could cause wild swings into the tail risks?
Well, the most immediate trigger is the inflation baseline. The source pulls in the May Consumer Price Index, which came in really hot at 4.2% year over year.
Which is way above their 2% target.
Exactly. And normally the Fed might hesitate to hike aggressively because expensive borrowing leads to corporate layoffs, but the employment data is incredibly strong right now.
So they aren't worried about breaking the labor market.
Right. That strong labor market acts as structural cover. They can attack that 4.2% inflation problem aggressively.
Which totally validates the dark horse bets on the board, the hawkish tails. I'm looking at the 4.25% contract, which requires two distinct rate hikes. It's sitting at an 18.8% probability.
Yeah, that's gaining serious traction.
Then there's the 4.5% or higher bucket. That's at 8.15%. And the source directly ties this to geopolitics, right?
It does. It relies heavily on the risk of the Iran conflict intensifying, specifically fears of the Strait of Hormuz closing.
Oh, wow. Because if that choke point closes, global energy prices just spike instantly.
Exactly. It's the primary artery for global oil. And since oil is the foundation for transportation, agriculture, you name it, an energy spike bleeds into the headline CPI within weeks.
So that 4.2% inflation print could easily compound to 5% or higher, forcing the Fed to just slam on the brakes.
Right. But we also have to look at the other side of the board. The dovish contrarians.
Oh, yeah. The people betting the other way. The 3.5% contract is still holding a 7.65% probability, and it offers a massive 13 times payout. What is the thesis there?
The thesis is basically that Chairman Warsh is just bluffing.
Bluffing, like a poker game.
Basically, yeah. A rhetorical tightening. The idea is that if the Fed sounds hawkish enough, bond yields will rise naturally, which tightens the economy without the Fed actually having to pull the trigger and hike rates during an election year.
That makes a lot of sense. So they're betting the Fed avoids a hike at all costs. But what about the extreme dovish tails? I see contracts for 2.75% and 2.5% hovering under 1% probability. It's like buying a lottery ticket.
Yeah, a lottery ticket for the apocalypse. To hit those targets, you'd need a sudden, massive economic collapse or a severe deflationary shock.
Right, because the whole debate right now is about hiking. To cut rates that aggressively, something the system has to fundamentally break.
Exactly. It's purely disaster insurance. The really smart capital isn't playing those apocalypse tales. They're focused on navigating the specific calendar of catalysts.
The catalyst calendar. Let's get into this. Because leverage traders don't just buy a contract in June and take a 6-month vacation. They trade specific dates.
Highly specific. The first major one the source outlines is July 14th, which is the release of the June CPI report, the key inflation read.
So they get in before the data drops and then sell into the volatility the second the algorithm digests the numbers.
Right, standard rumor and news trading. But the actual FOMC meetings are where it gets really interesting. Look at the July 28-29 meeting.
Yeah, here's where I need some clarification. The source says there is currently an 88.8% probability of a hold at that July meeting.
Right. Almost a certainty.
So if it's basically a 90% certainty that nothing changes, why trade it at all? Where's the edge?
Because the decision on the actual rate for July is totally irrelevant to them. They aren't betting on the action. They're betting on the rhetoric. They're betting on the press conference.
Oh, so they're listening for clues about the fall.
Exactly. They want a hawkish hold. The rate stays flat, but Warsh says something that explicitly primes the market for a hike in September. One phrase can shift millions of dollars and instantly reprice the December odds.
Which sets up the September 15-16 FOMC meeting as the major repricing event. Because that's when we get the new dot plot.
Yes, the dot plot is crucial here.
For our listeners who might not stare at Fed charts all day, the dot plot is this visual scatter plot. Every single Fed official anonymously places a dot on a grid to show exactly where they think rates should be at the end of the year.
It's the ultimate anonymized sentiment map. And by September, they will have observed months of new inflation and jobs data. If that cluster of dots shifts upward even a tiny bit, it mechanically validates the whole hawkish thesis.
The 4.25% contract could just take over as the new baseline.
Instantly.
But then, right after that, the calendar hits a massive speed bump. The October 27-28 FOMC meeting.
Ah, the politically sensitive meeting.
Yeah, right before the November 3 midterms. This is where I want to push back a little bit. Aren't central banks structurally designed to be strictly independent from politics? Why does an election matter to a mathematical equation?
In theory, they are completely independent. In practice, that independence becomes a huge liability right before an election. Any move they make will be interpreted through a political lens.
Because a rate hike hurts the incumbents, and a dovish pivot looks like they're trying to juice the economy for votes.
Exactly. So they are paralyzed by the optics. And the prediction market knows this, so they price in that paralysis, which ironically creates massive volatility.
It's so wild that they are literally monetizing political anxiety.
They really are. And then you have the outcome of the November 3 midterms themselves. That dictates future fiscal policy. If the new Congress leans toward massive deficit spending, the market immediately prices that in as future inflation.
Which feeds right back into the final December 8-9 FOMC resolution.
Exactly. That's where all these probabilities finally collapse into reality.
So bringing all these threads together, the big takeaway from this analysis is that the Fed rate isn't just a sterile number decided by bankers in a vacuum. It is a living, breathing reflection of global anxiety.
It's basically the apex metric for the global economy.
Right. It tracks the 4.2% CPI, the geopolitical friction in the Middle East, the labor market. And by watching where this leveraged money flows, like seeing it migrate from the 3.75% hold up to the 4.0% hike, we can actually see the market's evolving thesis in real time.
And that is the true listener value here. Whether you actually trade these crazy leveraged contracts or not, you need to understand them. These probability markets act as an incredibly sensitive early warning radar.
A shortcut to reading the economic weather before it hits your wallet.
Exactly. It gives you a leading indicator of where borrowing costs and inflation are heading long before it shows up in traditional news.
You get to see the storm forming before the first drop of rain. It's fascinating. Which leaves me with a final, somewhat provocative thought to ponder, something that wasn't really explicitly covered in the source but feels completely relevant.
I'm intrigued. What is it?
Well, if these highly leveraged prediction markets can react to inflation prints and global conflicts faster and frankly more accurately than massive traditional institutions, at what point do central banks stop leading the market and actually start taking their cues from these very prediction platforms?
Oh, wow. Like the tail wagging the dog.
Exactly. Are we watching the boardroom slowly surrender to the decentralized battlefield? Something to think about the next time you hear a routine update about boring old basis points. Thank Thanks for joining us on this deep dive.